Hello guys, welcome back with Wealthy Banda. Today we're having a special episode with a special guest, the CEO and co-founder of Nada Finance, John Green. Now, if you are not familiar with Nada Finance, it's one of the most promising real estate app to invest in 2023. So in today's video, we got so much to unpack from what exactly is Nada Finance, how does it work, and what makes it stand out from the competition. This being said, let's go ahead and jump in. Hi John, how are you doing today?
Hey, I'm doing very well, Mohammed.
Thank you so much for joining us. We are really happy to have you here with us in the Wealthy Banda. And we are really honored. So, I just wanted to say thank you so much. I know it takes us forever to go ahead and plan this. So, I'm really happy it's finally happening. Yep. So,
Same here.
yep, absolutely. So, I got for you a few questions. We're going to start with the easy one.
Okay.
The first one is, what is Nada Finance?
Easy, right?
Yeah.
So, not a finance is a wealth tech platform, meaning that we create financial products that we believe create wealth opportunities for the masses. In particular, we are a two-sided marketplace. So we support two sides of residential real estate, in particular the home equity side. So what we're going to talk about today is on one side, let's say over here, we issue and manage these series of real estate investment funds called city funds, so that anyone can buy interest in homes in a particular city, say Austin, Dallas, Miami, etc. So we issue, manage those, we make them available to anybody, any investor can jump in $100. So on the other side, we do direct to consumer finance on a similar product that becomes an asset, and that is a home equity investment. So for homeowners that have a bunch of equity in their house but no way to access it outside of debt, we provide a home equity investment, which is a non-debt alternative. It's a equity investment that's an option agreement. It allows the homeowner to get cash today, no monthly payments, no interest, and then that becomes an asset to the fund that we are then co-owners in these homes. So both sides providing access and liquidity to residential real estate.
Okay, so I'm gonna try to stretch this out because I know for especially people who are new to Nada Finance, this might sound a little bit confusing. So my view right now, when I look at Nada Finance, what you guys are trying to do, I believe you're trying to be the index fund for cities. So if I go ahead to Apple Store, Google Play, download Nada Finance, it will show me a bunch of cities, and I can go ahead and invest $100 in each. So would be is that an accurate description? Like if somebody asks me what Nada Finance is, I will tell them index fund for cities. Instead of investing in a home, instead of investing in a REIT, invest in a specific city. Now
That's
I know you
correct.
have the
Yes.
other, yeah, yeah, and I know you guys have the other side, and I'm gonna dig into it. I want to go ahead and jump in home shares in a bit because I know it's really interesting. There's a lot of real estate app coming to the market. Some of them are coming with nothing other than another flavor of what's already in the market. You guys are bringing
Yeah.
two whole new products, and that's
Yeah.
probably what adding a little bit of complexity, but also what make you guys are exciting. I can go ahead and have two products instead of investing in one. So my view is Nada Finance, and I know it's all under the Nada Finance umbrella, but the app itself, for an investor view, it's an index fund for
Yeah.
cities.
City funds. That's right. Yeah.
So if I want to go ahead and start today, I got my $100. I want to go ahead and get started. What do I need to do?
Yeah. So the way that you get access to the City Fund is you download the app available in the Google Android Store or in the Apple App Store. Not a finance. You can search by City Funds. Either way, you'll get there. It's a quick download. Anyone that's invested in any type of alternative or even just a stock trading app, it's a very similar sign up flow, very quick way to get onboarded. And the beauty of that is you go pick the Austin City Fund and you invest $100. Immediately that $100 is dispersed across multiple properties throughout that city. So you get exposure to a ton of homes in a single city with one investment. And all of our investments are in the money, meaning that there's an equity upside. So you're in the money in multiple homes day one. And again, the onboarding is very simple.
That's very nice. So let's jump into the home share. So as I mentioned, you guys have two
Okay.
products, and home shares come into another finance. So when I go ahead, download the app, choose to invest, for example, in a city like Austin, it is giving me this. It show me like, look, we have in Austin 30 property, X amount of them is home share. X amount of them are actual rental. So for me as an investor, what is the home share means? How does that work? Why would I want to invest in home shares and just invest in an actual property that you guys go ahead and purchase and manage? Why home shares is interesting for me as an investor?
Yeah, it's a great question. With the home shares product, we're able to make fractional investments into homes, predominantly owner occupied homes. So just like many people may understand that you own a home, you buy a home because it's an appreciative asset. It's unlike a car, the value is going to go up. So that's the equity. And when we're making these fractional investments, we're able to get many investments very quickly throughout a market. So you get diversification. So on average, especially in Austin, I'll just use that fund as an example. The average investment we make into a home is $45,000. Okay, and so the majority of the home is still owned by the owner, right? They'll have a little bit of debt, but generally the majority is owned by the owner, and so they're managing their property. They're getting the majority of the equity upside. We're just sharing along in there with it. So we're making that to where any investor in the city fund is sharing in that as well. And because we're providing a homeowner cash for something that's historically illiquid, where the only way to access is take on debt, then we're doing so at a discount. So in typical, when we make an investment into a home, it's actually worth 20%, 15 to 20% more than what we're paying for it. So that's where I go back to in the money. It's something that is worth more than what we're paying for. And so that's realized by the fund. So the fund has, an accelerated interest in a home, fractional investment into a home. So you have self-managed, diversified, and highly appreciative.
So I have a margin. So when you guys go get invest in one of these homes using the home shares, I'm actually not going in and paying the actual value of a house. And instead of I'm paying like 80%. So I'm getting it on a discount. So that gives me an
Mm-hmm.
additional access, even if the market goes down, it gives me some little bit of protection. That's very
That's perfect.
interesting. So
Yes, downside protection. Yes, yes.
perfect.
There's
That's
substantial
very
downside protection in each investment.
absolutely. So another question in the current market. So we know the market right now is not in the most stable state. Would you recommend for somebody to go in and invest in the current market status? What's your take on the current real estate market?
Yeah, real estate, we have the advantage, especially when we're talking about all the alts, right? Real estate has been historically the most stable asset class. And so instead of getting too consumed in trying to predict the future, you could just really look back at historical trends, going back all the way to the Great Depression and different eras, and you could see really, there are cycles, but there's got a one premium that we're not manufacturing anymore of, and that is land. So in a city like Austin, there are certain macroeconomics that are stabilizing market prices, but there's still a very simple issue to where there is more demand than there is supply. More people want to live in Austin than they have homes and roadways and stuff to occupy that. So that's the other aspect that we can actually solve for, is to where Austin may be very hard for someone to go buy a rental property in because there's just no inventory, or if it is, it's too expensive, right?
Sure.
But there's a lot of people that live there that don't want to move, and so there's a lot of opportunities to make fractional investments to give them cash for their appreciated value, and then we're able to create opportunities with that supply demand. So it's unique in our fund and how it can take advantage of either a booming market or a stabilizing market, because there's always access to unique asset class and inventory, if you will. And so yeah, it's the same thing. Downside protection is going to protect against too much market decline. A typical downside protection for us is we take the appraised value of the home and we discount it by 10 to 15%. That's day one, right? And so when you have that, and then by nature of the contract, home price appreciation rates might be 5% per year. But the contract has a multiple in that, the home equity contract that we invest in with city funds. And so it actually goes at around 2 to 2.5x what the home price does. So you have continual accelerated interest. And said differently, you have continual downside protection to ensure your equity buildup is there. So we believe, it's these markets and real estate in general is pretty consistently up and to the right. And so there's always a good time to get in.
So one major concern for the home shares, the
Mm-hmm.
way it works, you guys are going to somebody who already have a house. He is able to liquidate part of their equity instead of going out and getting a loan. How do I know, this guy? went ahead and do so, maybe he will maintain that house forever. When do I make sure I'm gonna get return on this home share? So is there like a time frame he have to return the investment plus, like whenever he
Mm-hmm.
go ahead and give you back the equity? How does that portion work? Because I don't want to invest in a house. Like if I'm buying a house, usually, especially if it's, your first home, it's gonna be for me there for the next 5, 6, 25 years, God knows, right? So how do I actually go ahead and realize that value?
Yeah, that's another great question. There are trigger events that would require the payoff of a home equity investment or home share product. And the common one, the one that we're still seeing most common, is someone selling their home. Typically, a person's going to sell their home or refinance their primary mortgage, which is the other trigger, within 4 to 6 years. Just generally, that's this market average has been for a long time. And so, because we're coming in at different points of when they bought that home, we see different cycles. So, in a short amount of time, we've already realized payoffs on now 6 of our investments. And again, a very short amount of time. We started making investments in late August of 2022. And so, over time, as the volume of the fund, increases and the age of it starts to go, it'll be more standardized, right? But you're typically looking at a 4 to 6 year payoff cycle with a backstop that is a 10-year contract. And so if the home equity investment isn't converted, then there is a forced sale and our cash payment that comes in, just like any type of debt would have a default if you didn't
Perfect.
pay it back.
Okay. So just to simplify this, you guys go into a house. Let's say the house value is $100,000. You guys are
Mhm.
entering in. Say, for example, you're taking 50%, but you are buying in with a value of $80,000 in order to protect, because of the appreciation, market variant, and so
Mhm.
on. And if he come in and sell it maybe in 5 years, and let's say it's a very good market and it jumped to 200,000, my return of investment when they sell, I will be getting this return back into that city fund as a $200,000 value, right? It's not back to 80, it's not 100. I'm getting that return just like the homeowner.
Yeah,
So,
you would. So let's say it's a 10%
sure. Mhm.
discount to value, $100,000 home. So we'd
Okay.
say it's worth
Mhm.
90. For
Mhm.
simplicity, let's assume they don't have any mortgage on it,
Sure.
right? Because we're always
Perfect.
buying a percentage of the equity and not the whole
Sure.
home. So if the equity is all of it, then it's okay. Let's say now we've got a $90,000 valued asset that has a market value of 100. So and they want to get 45,000. Okay, so they want to get 45,000. So we say, well, we'll give you that, but in exchange, we get 50% because that's 45,000 is 50% of the 90,000, right? So we get 50% interest in your home's future value. And so in that case, we'd have $45,000 in day one investment. In the future value at 200, we would get 50%. The fund would realize 50% of the difference between 90,000 and that 200,000. So it would be 110,000 times zero point 0.5. I'm sure everyone can do the math. It would be a pretty
Yeah,
lucrative deal, right? And then
absolutely.
that's the uniqueness of this asset. Those familiar with venture capital or anything, it's like the safe note concept of or a convertible note investment into a startup company, but into a home.
Awesome. Okay, so we're gonna move on to more of who's John Green. So you guys coming up with two interesting concepts. Again, I have no idea how you guys were able to bring these two together. Give us a little bit about your background. How did you guys come in here? I know you are the co-founder. Tell us a little bit more about you and how did you guys able to come up with Nada Finance? And one more question for you. As far as Nada Finance, was that planned from the beginning, the index fund, or you guys came up with it later? Because just a heads up for people who are not familiar with this, I actually invested in Nada Finance on an early stage, which was nothing but home share. So I'm really interested to learn more about that.
Yeah, that's a bunch of good questions. So about me, I am, in my late teens, early 20s, I had a weird experience that has really kind of defined me. I ended up starting a punk rock band with a few friends, and we found ourselves signed by a record label. I had the opportunity to do that full time for 4 years. So I released 2 albums, and we toured all over. So we all took it serious. It's silly to look back on, but we were a lot of vulnerability in creating, and also a bit of a nonconformist in how I am just kind of always at heart a bit of a punk rocker. I ended up ending that somehow going into mortgage banking, I worked for Washington Mutual for a while, and then they got acquired by J.P. Morgan. I worked there, and I worked my way throughout 10 years in the financial services sector, primarily in mortgage. And so I kind of have this duality, right? This like financial strategist with this nonconformist punk rocker. And I'd say at its core, that's what consistently led me to think, real estate, broadly speaking, is the largest asset class that literally affects us on a daily basis. Yet it is so incredibly specialized and privatized in both language and access, throughout. And so when we set out to create Nado, we set out to create a platform that could provide sustainable financial solutions that would unlock, real estate wealth for everyone. That's always been our vision. And we always knew that we wanted to provide a debt alternative, that their equity is real, just like an IRA or any kind of a stock investment or anything like that. Like it is a real value. And so can we create a product that allows someone to access that in times that, we're currently in, where there's inflation and just, all types of downward pressures on homeowners to access equity. And so the answer is yes, you can. And then it's how do you get money to finance that? Because there isn't an established secondary market or investors behind a product like that, because it's still pretty new, still pretty esoteric. So we actually, and I think you were alluding to this, we NADA raised a Reg CF, a regulation crowdfunding round in 2021. We did so on the platform called Republic, one of the largest regulation crowdfunding platforms. And it was an amazing experience. So many individuals got to invest. We really built a great community. And I learned quite a bit about that sector. And I got to know Jesse Stein in particular, who had just joined Republic. He had sold his company, which is a real estate fractional investment platform called Compound. And we started talking about the fractional investment into homes, the home equity investment, home shares, and the concept of city funds was born through that. And we initially launched it with them. So I would say no, the index-like funds for this was not what we planned, but it was an amazing pivot and opportunity that we saw as we've continued to mature.
Very nice. Okay, so you owe us the records. You guys have them on YouTube or Spotify. I'm gonna ask you to provide us a link. We're gonna put it down in the description.
I don't know.
we,
We'll see. We'll see. Yeah.
Okay, so we're gonna have to go to the tough questions. So, again, amazing concepts. If God forbid, Nada Finance goes out of business, what happened? Again, if I'm an investor, I go ahead put money in, and we've seen a few apps already going out of business.
Mm.
What happens to me as an investor in the platform in a given city? Again, God forbid, but question on everybody's mind: how do you guys like? What do we expect to happen if God forbid Nada Finance go out of business?
Yeah. No, I understand. So, well, unfortunately, NADA is in a good position. We have great investors and backing. So, just want to make sure I say that. But because of how, remember, so NADA is a licensed mortgage originator, a licensed real estate brokerage, a licensed insurance. I mean, kind of insert here over and over, and then we issue and manage the funds. So we have a separate side of the market and an income stream that can operate independent. But also, what it does is it creates the relationship that we have with the city funds is a management relationship. So it means they're bankruptcy protected. So the city funds management entity is a separate entity outside of NADA and that we participate, in ownership of. And then each of the funds themselves are series LLCs. And so these are portfolios of assets that are also not what you call cross collateralized. So there's layers of bankruptcy protection throughout that, to where the investors in a city fund would not be exposed to, the going all the way back to the NADACO side of the business. And so each entity, so in the event, for some reason, to your point, God forbid, right? NADA is out of business, then city funds continues to operate. It's an independent vehicle that's not directly connected. It's bankruptcy protected by the design of the management relationship and the series LLC structures.
Perfect. So ideally, God forbid, if the platform itself goes out of business, still each city fund will be acting separately. And, as an investor, I will still get my dividend on a quarterly basis, maybe just instead of in the app, I would just get them through a check or another way.
Yeah, I mean, of course, there's possibility that to afford for technology and expansion, et cetera, it might not be there, but you would still get it. In particular, Jesse Stein, who's a board director, is a co-owner and the manager who is not an employee or part of NADA. So there's operators in place, and yeah, to
So
continue paying out dividends and managing.
perfect. So you mentioned that Nada Finance is in a good spot. I want to ask you, can you a
Mm-hmm.
little bit elaborate in there? I know there's, runaway as well for startups. So if you can go ahead and touch with it, that's definitely will be very helpful for our viewers.
Yeah, sure. So Nada closed a price equity round last year, last June, July range, led by an institutional investor called Live Oak Venture Partners. The managing partner there is a member of our board, and just a very great group. So really good group. We raised for that round a little over 5 million in that round. Many other good investors in there, inclusive of Capital Factory, a large VC in the Texas area, as well as Revolution Ventures, which is a multi-billion-dollar fund that was founded by Steve Case, the individual that founded AOL. Also, great people, great fund, and we actually. It's a silly term, but it's true. We oversubscribed, meaning that people wanted to buy more than we were willing to sell at that price. And so the Revolution team actually led a post-closing investment into Nada on a safe note. So after we sold the price equity, we actually raised additional capital on a safe note led by them. And we continue to have opportunities to extend that. So all in, since we've been raising capital, I think you saw this. We once raised right under 2 million from the public. So we've raised around 9 million in venture capital, equity capital, and we just recently announced closing a $2 million venture debt line with Silicon Valley Bank, now Silicon Valley Bank of First Citizens. So we have access to cash, thankfully, and a really good team and investor support. So you would want to look at like the lifeline. So a company at our stage, kind of this in betweener of a seed stage to a Series A. What's your cash flow or what's your runway on cash? And we have in excess of 13 months, presuming we stayed kind of flat. So it's a position that if you
That's
know
a
the
very nice.
nuance of startup
Yeah.
money, it's one we're very excited and privileged to be in.
Yeah, this is very nice for startup. 13 months of runaway. It
Yeah.
give you guys a lot of time to focus on the important stuff and not worry about it. So that's awesome. Okay, so I will jump for another important question. But before I go ahead there, I have one more question for you. So I was one of the lucky people who get an opportunity to invest in Nada Finance as a platform in the past. And I love this about Nada Finance. Unlike most of the other real estate app, technically you guys it's owned by the investors, right? People come in
Mm-hmm.
through Republic, they invested in. Are we expecting in the future to see another round where people who invest through Nada Finance can invest in Nada Finance itself?
That's kind of eerie that you would even ask that. I recently had a board meeting to discuss the opportunity of doing another community round. It's we like to call it. We have because we are an investment platform. We previously raised from 4,000 individuals. There's just a whole lot of power in that, and yeah, we're going to have an opportunity coming up soon to where we're going to be extending not a sizable amount, but to where we can offer a little bit to the community to invest and kind of follow along on our progress.
That's very exciting. Now let's take a moment and talk about taxes. How are you guys taxed? What is the advantage when it comes to tax position to invest through Nada Finance than go to maybe I guess public REIT and invest in it?
Yeah. So disclaimer, your personal situations could all be different, so you should always talk to your tax, advisor. But by design, the funds are REITs. The REIT has such an old school kind of connotation, but they are baskets of qualifying real estate interests with a distribution plan for dividends to be paid out that meets that requirement. And so for us, at the end of the year, we'll intend to qualify as a REIT. So we can't guarantee that, but that's the intent and the whole design going into it. Um, and the investments themselves, the home equity investments in particular, because they're forward flow purchase agreements and not real time, so they're tax advantage even for the homeowner as well as an investment asset. It falls into the same real estate type. So, kind of simple answer to that is the design is to be as tax advantage as a REIT and structured very similar. Even the uniqueness of our asset has tax advantage on both sides. But
Perfect.
you should talk to a professional.
Completely understood. Yeah, I just wanted to point out because I know not every platform take advantage of the restructure. So this was like takeaway. You guys
Yeah.
are taking this into consideration. You are structured as a REIT. This is very important. Okay, so
Mm-hmm.
I have another question for you that wasn't even the plan, but you can blame another finance team later on for it. I just saw today you guys pushed for me a notification saying, "Hey, Nada Finance, if you invest $1,000 today, you get $100 in shares." So
Mm-hmm.
this is until end of May, so I'm looking forward for it. But my question here is, if I got $1,000, I want to go ahead and invest it, and you guys have four different city. If I invest 250 in each, do I still get the credit for the other 100? How does that work?
Yeah, not right now. So the program that we rolled out is for if you invest at least 1,000 in any of the active city funds we have. We have four active ones. So that's
Yeah,
Dallas, Austin, Miami, or Tampa. So if you invested 1,000 in Austin, you would get $100 worth of extra shares in Austin, and you could do that for each of them. So you could make you in total you could earn $400 worth of extra shares. Uh, we are excited about that. I made the decision this morning to extend it because we had quite a few people that came in that had tried to get into the app at the end and had some either technical issues or just wasn't able to get in there and understand the timing of it closing, kind of a random date that we had set, I guess, in hindsight. So we're extending it. One of the most exciting things, and probably the whole core design of a city fund, is at the end of this month, we're going to update the NAV for the three most seasoned funds: Austin, Dallas, and Miami. And so afterwards, that'll be a process that we do on a monthly basis. So by updating the net asset value NAV, that's updating the share price. And that's the whole design. So remember that when we make investments, they're in the money and they're appreciative. So it really creates this opportunity. By design, you'd want to get in at the earliest if you believe that real estate is going to appreciate in value. And so that's why we wanted to make sure we afforded folks to get some extra shares.
perfect. So I'm glad you touched on the NAV. So right now, when I go ahead in the app, I invest, for example, in Austin. I see Austin maybe 2.5% up. I see another city is down. How do you guys decide if this city is actually up or down? Like, what is the measure that's being used?
Mm-hmm. Yeah, so it is net asset value, and for us, that is a bit straightforward because we both focus on originating these investments. We're very hyper focused on how we appraise and the systems we use for that. So when we go in a value appraise the value of a home to make an equity investment, we then lock in how we valued that home, and then we manage the valuation of that home similarly on an ongoing monthly basis. So we actually have API relationships with multiple data sources, but primarily we use the three main market automated valuation models, AVMs, to come up with a confidence score on a per month. So we're actually just tracking the underlying asset value and our interest in it in each home across all of the funds monthly. And so it's a direct actual correlation to the underlying asset value. Nothing arbitrary, nothing based on someone's willingness to buy or sell high, whatever. It's actually based on the underlying real estate.
That's very nice. Okay, I'm gonna go to the last question, and thank you so much for your time. Now, I want to go ahead and get started. I haven't started investing yet with Nada Finance, so I'm gonna go ahead and start with your life right now. Now,
Go for it.
my question: you guys have four different cities,
Mm-hmm.
and I want you to go ahead and tell me. And I know this is a very hard question, right? Which one of these four is your favorite? If you're not comfortable to say which one is your favorite, it's okay. You can tell me, okay, if I would have $100 only, I got my $100, okay, where would I put them in any of these four? So, you can pick one. It doesn't have to be even, based on real data. You can tell me, I just feel more emotionally attached to a given city. I will take that.
Yeah, well, I would say so. I lived in I live in Dallas now, so there's that. But
Nice.
but I lived in Tampa and St. Petersburg, which is right in the same metro, for like 2 years in the kind of the duration of the band time, and I love that area. I think that area is amazing and has a lot of good memories to me, and the market is doing really well. So my immediate response is Tampa.
All right. So again, I'm not taking this as a financial advice or anything, but
Not a
I'm
problem.
taking
Yep.
your recommendation, and I'm gonna go ahead and start my first investment in Nada Finance on Tamba. So I'm all set with Tamba, and this brings me another question. So if I go ahead and add another 900 now in Tamba, for example, it would allow me to go ahead and qualify for that credit. It doesn't have to be all at once. Like I can go ahead and add up to 1,000, and I will
Correct.
get the
Yeah.
credit as a perfect. Awesome. Okay, this is
Correct.
very
Yeah,
exciting.
there was a start date back at the some point in April, and it's all in the app for the terms. It's going to run through the end of the month. So yeah, and you said it right. It adds up.
Awesome. Okay, I'm very excited. I'm gonna go ahead and add up in a bit. Thank you so much, John. I highly appreciate it and wish you guys best of luck in this journey. Again, amazing app, and thank you. Like I really love the fact that you guys have two different products coming in together. So thank you so much
Mm.
for your time.
Thank you. Thank you for having me. I appreciate it.
I hope you guys have enjoyed this video. If you did, make sure to go ahead and subscribe if you are not subscriber, like this video and turn on the notification button. Thank you guys and stay tuned with Wealthy Panda.